Good afternoon. Peter Klein, Chief Investment Officer, co-founder Align Wealth, here with you on the 21st of January to talk a little bit about a sector call that we'd like to discuss in the energy sector. So we believe that there's a strong possibility of increased inflation. I know you've been hearing about this in the popular press and in the market-centric media, and it seems to us like there's a very good possibility that this has legs. This idea that real assets and inflation-sensitive assets will appreciate for the next let's call it a year or two. A lot of this comes, as you'll see, because of the fact of the massive amount of spending by governments around the world, and because of the debt levels that those governments have taken on. This is in part that's leading to this idea of inflation. And while the central banks may sort of like the prospects of inflation, that's what they've been trying to get going, this may be the worst time for that, if indeed we do not get the growth of the economy, but rather just essentially inflation due to asset levels rather than the actual Main Street economy. So it can be the mentioned stagflation that occurs, and of course, if that was the case, that would be a difficult economic situation to find ourselves in. So allow me to share my screen, and we'll go through this as an exercise. As you see in front of you, now you do. Our take is one whereby we believe, as we've said in the last few video chats, that animal spirits sentiment has gone somewhat amok. And we're seeing that in this sort of notion of the casinofication of the market, where you have young people investing in a way that's not typical, trading defunct companies and stocks that are bankrupt and options which are very speculative. This is all part of this idea that there's a speculative frothiness to this market, and we see that in many spots, not only in the idea of gambling and speculating, but also many folks see no fear in the market. And when we see these levels of sentiment that are this high, it's typically a telltale sign that one needs to be somewhat careful. There clearly is a substantial disconnect between stock prices and earnings. There's a fair amount of, usually there's a high correlation between earnings growth and stock price growth, right? And now we've not seen that since this time last year, I guess. And so we're worried that may have some impact to stock prices over the course of the next 3 to 6 months. So again, this notion of driving with one foot on the gas and one on the brake, we still feel like that is the right way to go ahead here. However, less so than last month. Okay, so now that we're past the sort of seasonal Christmas period into the inauguration yesterday, we believe that now is sort of like, okay, honeymoon time is over kind of thing, and so maybe less foot on the gas and more on the brake. And we talk about the real assets. So here's in a large part, this is part of why we think there is potential for inflation, and a lot of it has to come down to the idea that there's so much debt in this system. And I know I've said that time and time again, and I know that others have been saying it for what seems to be for years, but it doesn't go away that quickly. $80 trillion of debt doesn't evaporate like that unless it's inflated away. And so it's interesting to us that this might be the modus operandi of many of the central banks across the world. So this is, it's data point number one to us, is the huge amount of debt that's out there, and how is that going to be repaid? Clearly, if it's repaid in less valuable dollars because of inflation, that would be good for the central banks. Okay, here's the velocity of money. So this shows you not only the M2, the huge growth in money supply, but the speed of that money going through the system, and you can see how that is reduced, and that shows you that there's pent up potential inflationary issues. Now, we are talking about the energy sector. This is the idea here today, is the energy sector, unloved and underappreciated. This is what we like, right? As contrarians, as value investors, we want to seek out those asset classes that have been misunderstood or thrown out with the bathwater, as the old quip it says, and we want to buy those because we're buying them at great valuations. That's the key. Folks, they've looked at, in seminal study after study over 100 years, the greatest factors, the greatest determinants of investment success. Not over the short term, right? No one can really determine the short term. It's noise or noisy, right? But over the long term, call it 5 to 7 years, an investment cycle. So all these research and academic studies have been shown that the highest R squared, right? That's a statistical correlation. The highest R squared that shows the determinant that is most affected, or the stock market's most affected by this determinant, is not the president or the party or the Congress or interest rates. It's what you pay for that investment when you buy it. That is the primary determinant of investment success over the investment cycle. So if we're buying something that's unloved and misunderstood and cheap, but clearly still needed, I mean, we are strong believers in sustainable, responsible investing. However, it's impossible to think that we're going to just not need fossil fuel overnight. I mean, it's going to be here for a while to come. And many of these companies are recreating themselves to be more environmentally savvy. So the notion that it's just going to go away is kind of silly to us, frankly, and where we would be buyers when things are so depressed and so unloved. And we believe energy has done that. As you could see here, that the weight in the S&P is down to 3% from where it was at about 6%, 5.5%, 6%. So unloved. And here again, you see more statistics, the price to book, the price to sales, all very depressed. It's come up in the last couple of weeks a little bit. We believe it's got a ways to go. The last time oil was near $50 a barrel, the S&P sector was closer, it was 17%, the energy sector. So it goes to show you how things changed fairly dramatically over the last few years. Okay, so we talked about inflation. We spoke about the governments around the world spending money. We believe this is the push that's going to get inflation going. The M2 money supply, of course, as we spoke about, and how commodities have been in a bear market. We call them real assets, commodities, lumber, oil, copper, precious metals, farmland. That's all in that same genre. And they acted very poorly over the last 10, 12 years. We believe a regression to the mean makes some sense. Again, we want to buy what's unloved, what's cheap, what's undervalued. So here's a talk about the pivot. As you can see here, you have inflation going one way and in real activity going the other. And we believe that this inflation boom, assets of choice, cyclicals, foreign equities, value foreign equities, because you'll see dollar weakness here. So we're positioning ourselves in value. We have, as you know, a case for gold. Please watch that video. You'll see that on our site at alinewealth.com. We believe this is where we want to be migrating some assets towards. And here's that aforementioned commodity index, and you can see how poorly it's performed over the last 10 years. It had gone from 36 to 9. That's a negative 13% CAGR. Okay, so that's pretty serious compared to what everything else has done over that same period. And yet gold miners are less than half expensive versus the NASDAQ 100. We think this is an interesting trade to sort of fade the NASDAQ 100 positioning, that's this line, and to add or buy into the we call gold miners indexes in that sector. So it's a sector trade or sector move. To us, as being contrarians and value investors and seeking what's unloved and undervalued, we think that's an opportunity. Well, that is our discussion for today. We want to thank you at ALINE Wealth for your attention today, and we're always here to go over your portfolio, to discuss the market situation and the economic situation of the day, to plan for your future, and to make sure that what the work that we're doing for your portfolio will get you through the next few years and into your planning for your retirement, into the future legacy of your family. That's what we do. We understand our clients very, very well. We optimize the portfolio through a defined process to get you through the wiggles and the ups and downs that we know life brings. And I'll bring you to our here's that life goes around and around, and we want to make sure that we're there. We know we will be there for you as your partners in throughout that process. So feel free to give us a call at ALINE Wealth, and we'll be happy to chat about your portfolio, the market, as well as the plan going forward. Have a great evening. Thanks very much.